Has your potential investor or lender asked you to send them a set of financial projections and you're concerned that your projections are not realistic? How do you know if your projections are realistic or whether your potential investor or lender is going to laugh you out of the room when they take a look at these? I'm going to try to answer that question for you, show you what kind of diagnostic checks that I look at when I'm trying to create a set of sales projections or reviewing somebody's projections to help give you peace of mind as you move forward. But first of all, my name is Adam Hoeksema. I'm the co-founder of Projection Hub, and we've been helping thousands of entrepreneurs over the last decade create sets of realistic financial projections. And today I'm going to be showing you exactly what I do when I'm trying to determine whether a client's projections are realistic. I'm going to be using one of our financial projection templates as a guide. If you don't already have a set of projections and you want one of our templates, we'll put a link to that in the description of the video below. We'll also put a link to a form that you can fill out to get a coupon code to get a discount on one of our industry-specific templates as well. So go down to the description of the video below and go ahead and grab one of those. So once you have created your projections, here's what I normally do. We'll go ahead and dive into this example. All right, so if you're using one of the Projection Hub templates, they all have an at-a-glance tab that makes this really easy to kind of diagnose whether the projections seem reasonable or not. So the first thing I always look at is this line right here, the net income or the profit margin percentage. So I want to see each year, what does that percentage look like? And is it reasonable for the industry? So I have our fast casual restaurant template up right here. And what you'll notice is in the first year, it's losing money, which is reasonable maybe for a first-year restaurant to lose some money. And then margins go up to 6% and then ultimately up to 16% by year 5. And so I'm going to take a look at some different ways to find out whether this seems reasonable or not. So the first thing I'm going to do is you should just do a simple Google search. Average profit margin for a fast casual restaurant, and you know what? You'll end up getting this perfect answer right up there, big and bold for you. You're going to be able to find that for lots of different industries. Just Google what's average profit margin. And so 6 to 9% gives me some comfort that those projections that we were just looking at are somewhat reasonable, maybe by year 5 getting a little optimistic, but within we're not talking like 60%. Sometimes we'll see projections where someone says, we're going to have a 60% profit margin in a restaurant. Well, no, you're not, because the average is 6 to 9%, right? So that's the first thing I take a look at. The second thing I'm going to take a look at is the cost of goods sold percentage. So again, on this table here, I see our cost of goods sold as a percentage of our sales. So in that first year, wow, it's really high, 74%. But maybe that's because we are still ramping up our customer base, but we have our whole staff team there available. And so maybe we're overstaffed because we're still growing into our size, right? And so maybe we're overstaffed, and then over time you see that cost of goods sold percentage comes down. And so again, we can do the exact same approach here. I would just do average cost of goods sold for a fast casual restaurant, and I find that's around 30 to 35%. Now, we were much higher than that in that set of projections. So again, I would probably look at that and say, wow, you really need to try to figure out how to back down your labor costs and your food costs. It's much higher than the industry norm. So that would be another thing that I would look at. All right, next, I would do a similar approach. I'd really look at these ratios and maybe total sales for my type of business, especially if I have a kind of a standard small business like a plumbing company or an electrician or a restaurant or a coffee shop, or things that are kind of easily understood, kind of what the max potential could be and what the norm should be. Then there's a tool called Bizminer. If you want to spend a little bit of money to find an industry financial report here, so if you come to bizminer.com and then go to the pricing tab, down here you'll find this industry financial report for $250, and it gives you 3 years of financial ratio data, and you can narrow that down on a national, state, and local level. And so you can really find, what is an electrician in Chicago paying for labor as a percentage of sales, or what are they paying for materials as a percentage of their sales, and you can understand what those norms should be, not just on a national level in your industry, but even on a local level, and see those differences, okay? So if you're prepared to spend a little bit of money to get these really dialed in correctly, you can use a tool like Bizminer. Now, the reason why this might be important in finding these different ratios, how much does a business spend on utilities as a percentage of sale? How much does a business spend on insurance as a percentage of sales? The reason you want to look at that is because your banker, your lender, probably has a subscription to Bizminer or something similar, where they're going to be taking your numbers and kind of comparing you to the industry norms and be looking for red flags. So that's why we like to recommend this. Now, this is useful for kind of those like small business, Main Street small businesses. But if you are a tech startup, a Bizminer report's probably not going to tell you what you need to know for a brand new mobile app product, mobile app that's never been built before. It's hard to know what the potential there could be. And so what we recommend there is we did a study in partnership with Starter Story where we reviewed 234 different tech startups, and we looked to understand their actual revenue numbers over time and stage of business. So we looked at these different types of businesses, so B2B software, B2C, direct-to-consumer products. So this would be like e-commerce businesses, and then marketplace startups like Airbnb or Uber. And we broke it down also by the stage of business as well. And so what we were able to find, this is the graph I think is most useful for you. Once you have your set of projections, you can come and compare your projected revenue at any given stage compared to your industry type actual revenue numbers. So here we can see a direct-to-consumer business, the average for a 2 to 4 year old direct-to-consumer business was 3.21 million in revenue annually. You can see for a B2C software is 1.28, B2B software 814,000, and marketplace 780,000 for that 2 to 4 year range. And you can see that the software companies really start to grow after that grow much faster, whereas the direct-to-consumer e-commerce kind of just has a flat growth rate, not that exponential growth that you might see in software businesses. So this is what we like to just kind of level set and compare. What are we projecting compared to what are some actual revenue numbers from these types of tech startups? Another area that we like to look at, and if we come back to our template here, you'll notice this annual revenue per employee. So this is another number that you can kind of use to understand whether you are within the industry norms. And so this is again for the fast casual restaurant, but a lot of our templates have this same metric here, the annual revenue per employee. It'd also be easy for you to calculate. You just need to know the number of employees you expect to have each year divided by your total revenue to get that number. And we did again another study where we looked at this annual revenue per employee for several different types of businesses. Again, we looked at mostly, again, the tech startups by those different stages and whether they were bootstrapped or raised money. And you can see average revenue per employee by business type. So one of the things that you'll notice here is that e-commerce businesses, because they have cost of goods sold, because they have shipping costs and the cost of the physical product, you need to have a lot more revenue per employee to make that work compared to some of the three software related businesses had a much lower average revenue per employee. But again, that will give you some good context of what to expect there. All right, so then the next thing we would do is we would want to know if we're going to be sending, especially if it's a tech set of tech projections, we'd want to know, what are the investors going to think when they see this? Yeah, we see what actual businesses are doing in terms of revenue, but what are investors used to seeing in terms of financial projections? And so we did another partnership study with Story Pitch Decks, where we reviewed 107 different sets of projections, again, for those 4 different types of businesses: B2B, B2C software, e-commerce, and marketplace businesses. And we were able to determine, also broken down by age of the business and like what stage they were at. Are they raising pre-seed, seed, or Series A funding? And here you can see how much they were trying to raise, how much revenue they projected based on the stage of their business. A lot of different data points here, but the idea here is that you would be able to make sure that your projections, if you're a marketplace business, that your projections are within what these investors are used to seeing. Okay, so you can see what other people are projecting and just make sure that you're not way out in left field and kind of going to get laughed out of the room. So that's the main thing that we like to do here. Now, the last couple things that I want to show you, if you've checked out with all of those, all that diagnostic check looks pretty good, the last thing I want to do when I'm looking at a set of projections is I want to make sure the balance sheet balances. So that's often a challenge if the balance sheet doesn't balance. And here we look at total assets should equal total assets and equity. I'm sorry, total assets should equal total liabilities and equity. I'm not sure what I said there, but if the balance sheet does not balance, then you probably have a problem somewhere in the model. It'd be an easy thing for a banker or an investor to pick up on real quick. So you want to look at that. And then the last thing you want to look at is your cash flow statement. So I always look at the cash flow statement. I come here to the cash at the end of the period. This is your cash balance at the end of the month. We want to make sure that that never goes negative. So look at each of the 5 years and just make sure that this line, you never see that go negative, because if it goes negative, it means you're bankrupt, you're out of business, right? You have negative cash balance, you've ran out of cash. So those are the 6 or so different kind of diagnostic checks that I'm going to look at when somebody sends me a set of projections and says, do these look realistic to you? This is what I'm going to do. And I hope that helps you as you're trying to figure out how to develop a set of realistic numbers. Hopefully this is helpful. If you would like to have us review your projections, happy to do that. You can go to support@projectionhub.com and send us an email and send us your projections, and we'll be happy to review those for you. All right, thank you very much.